gang? Welcome back to Market Monday with Isaiah and the team at Foundations Investment Advisors. So, a lot happened last week, Isaiah, in the market. Well, I guess we could say a little bit of a lot.
Yeah.
Like, just there was some jobs data that came out that was maybe surprising to a few folks.
Mm-hmm.
Maybe those of us who always sound like negative Nancy's. We're like, oh, I told you so. Here it is.
Yep.
So catch us up with weekly commentary as of September 5th.
Yeah. So as of September 5th, we saw the S&P hit an all-time high, closing at like 6502. So it's closed at an all-time high, and then it's kind of like what we've been saying in the past couple episodes. Market's saying one thing, and then all these other reports. It's kind of like the angel and the devil on the shoulder. In the U.S., you have the market's doing so well, it's hot, it's booming, and over here on the other side, you have the jobs reports and the economy saying a complete different story.
Yeah. I had a phone call with a friend of ours this morning who's always watching the market, always has his own personal commentary. And the sentiment that he gave and what I'm starting to hear now is people are starting to sound a little more concerned. I mean, jobs is a big indicator of how the economy is doing. And, with jobs reports off, now we're starting to hear the Fed say what?
Yeah, so they're looking, word around the block is we'll see probably a 50 bips or 50 basis point rate cut this month.
And probably being 100%, 80%, 50%, what?
Right now, I'd say it's probably in the 90 percentile that we're going to see a rate cut.
Wow.
I mean, the Feds are taking a very dovish look in the environment, in the economy right now. So they're definitely backing off of keeping the rates the same. I mean, like what Fed Powell said before a couple weeks ago was the pressure is really on the labor force. And the pressure
and now the labor force is...
The pressure was there.
Succumbing to...
Yep, succumbing to the pressure. So, yeah, I think my professional opinion, we'll see a rate cut this month. 50 basis points or less, but most likely 50.
A whole half point. Wow. Okay. In September. And then what about October?
I think there's a probability of Trump wants 4 to 5 rate cuts before
year end?
4 to 5 rate cuts bleeding into beginning Q1 of next year.
Q1 of 26. Okay. Are we seeing anything like in the, I think most consumers now, including myself, who are setting on what I would refer to as free mortgages, meaning rates in the sub-low 3s to 2s. I don't have any interest in selling anybody my house.
Yeah.
Right?
No, you shouldn't. That's free money.
Yeah. I mean, I'm sitting in a good spot. We've got a great home. And the interest rate's probably never going to see 2 again. But what do you think interest rates for home owners could look like? I mean, I think there are people waiting to refi.
Yep.
Because what happened, it seems to me, that people got high on real estate crack.
Yep.
To put it bluntly. And they bought McMansions, they bought big homes, but then they had to furnish those homes with drapes, new couches, new carpets, new stuff, pools.
I think what you're going to see in the real estate market is people that are currently owning a home or bought a home in let's say they bought it from the 4, 5, 6 range. They're holding their breath, waiting for the cut to see if it's going to make sense for them to refinance. I think a lot of 20-something-year-olds that are looking for their first home, I think it's going to be more of the same now that rates are going to drop. I think we're going to see more of a struggle and shift towards, the rates have dropped. Their monthly payment may go down, but these people selling the homes, if rates go down, what are they in turn going to think? I can charge more for this, and it kind of causes hyperinflation, in my opinion, on the housing market, to where it's
hyperinflation, or you think there's any chance for maybe stagflation, like we see some things just kind of peter out and not move really.
Yeah. I mean, there's a chance for that, but I think in the real estate market, I think we'll see home prices if you're
continue to go up.
I mean, they're dropping. The reason, in my opinion, the reason why you see housing prices dropping now is because the rates are in the sixes, and people got so used to astronomically low housing prices or housing rates at the 2s to 3s. They're like, oh, I'm not paying 6, that's a ripoff, or I'm not paying 7, I'm not doing that. So I think if you cut rates, you could see a little bit of price increase.
Well, I can tell you as the old man of the group here, going back over the last 100 years, and you guys in the control room, you can fact check me on this. Actually, let's do that. Pull up, I'm going to guess the average rolling 30-year fixed rate
6.3%.
is somewhere around 6.5. Yeah. Now, you said 6.3. Did you look at this lately?
That would be my estimate of an average.
Okay, so
because if you go back into the 70s and 80s, they were in the teens. It was like
Yeah.
like when your parents were buying.
yeah.
So that was like 13s. There,
Or-
yeah, 6.5.
So, yeah, bring that up on Market Talk Monday screen here. So, based on data through first week of 2025, 100-day rolling average for a 30-year fixed rate is approximately 6.5. The average rate during the first week of 2025 was 6.5. Trend in recent months, 6.5. Can you go back, Jake? Why don't we find what's the 100-year rolling average of 30-year mortgages? And I'd put 100-year there. Yeah, for mortgages, 30-year fixed rate mortgage was not widely until the 20th century reliable, consistent data from Freddie Mac back to 71. There you go, 7.71 from
Wow.
71 to 2025. So we went through a period, Isaiah. That's my point. Is that the record low rate? I think I saw it on the screen was 2.65. I've got a rate at 2.95, I believe, on my home.
Great money.
So I can go out and buy treasuries to multi-year guarantee annuities to pretty much anything. Money markets. What are money markets paying right
Yeah,
now?
money markets. Like here at Schwab, the 7-day yield was about 4.13%.
So I can go put risk-free money, theoretically risk-free, in a money market and continue to pay just the principal payment along with my little bit of interest on my mortgage. And the arbitrage, I'm going to win at that game.
Yeah.
So now what we're seeing is that housing prices have inflated because of that. Some would say appreciated. Your appreciation is my inflation if I'm buying your house.
Yep.
Your inflation is buying my appreciated home, right? So then I got to turn around and go buy
Another home
at
a higher rate.
or higher price. So what we've seen in the market now is that price has gone up
As well as the
dramatically,
rate.
as well as the rates. And so now what we're seeing is a disparagement between, or disparity between income and prices.
I mean, if you look back at the average income in the United States and look at what inflation has done, wages have not kept pace with inflation.
Yeah. So Jake, bring that back up. This is great about having guys that can just sit there and we can just kind of talk through this and bring it up while we're talking with, clients and consumers. Go in and let's look at in 1971, what was the average household income in the United States in 1971? Because we saw rates back in 1971 through 2025. Average was 7.71 on a 30-year fix.
I'm going to try to take a gander. I'm going to say like 21,000. Oh, I was way off. 10,000. 10,000.
The median family income in 1971 was $10,290. The median household income in 1970, just a year before, was $8,730. So the median family income was $10,290. And back then, the median family was husband, wife, and 2.3 kids, I think.
Yep.
So now, what was the median housing price in 1971? So the median housing price in 1971 was $28,200. All right, so Isaiah, let's look at this. Guys, if you can, pull up an amortization calculator for me. Let's put in that median house price, and we'll just say that person did 100% financing in 1971 on a loan, and we said the median household was $28,000.
Yep. So 28,000.
So let's say 100% financing. Let's say they were a veteran. Now, some would argue whether you can do 20%.
Yep.
We're not going to bury in that right now.
Their interest rate was 7.54 was the average, 1971.
All right, and let's just do a 30-year fix. So go to term years, 30.
30.
All right, so 196.55 was their mortgage payment.
Yep.
So here's what I want to do, folks. I want to take 196.55 times 12. That's $2,358.60 a year allocated to mortgage.
That's 20% of their income.
20% of their income went to housing.
Mm-hmm.
All right, you guys tracking with me? So now, Jake, leave that screen up. Let's go back to 2025. Or go back to the Google search engine here. I sound like an old man. The Google. Go to the Google. Now let's put in the median household income in the United States 2025.
83 to 84,000.
All right, so let's say it's 83,680. All right, so hold that number, Isaiah.
Mm-hmm.
Now, what is the median housing price in 2025?
Man, 83,680 sounds kind of high, doesn't it?
No, it
You
really
don't
doesn't. 435,300. Now let's do 100% financing, and just to be fair, 430. So put that in. Was it 430 or 435,000?
35.
435,300.
435.3.
All right, and let's find the 30-year average on money right now. We said the rolling average was like 6.5.
30.
But we'll just go ahead and give a break and say we can get the current rate at 100% financing. Should be in the sixes.
Yeah, 6.58.
Yeah, so put in 6.58. That's what I thought it might be, somewhere around there. 6.58, not 7.54, folks. And the average price is $2,774.34 a month. So now let's look at that. 2,774.34 times 12 is 33,292. Divide that by their median household income, we said was what?
83,680, almost 50%.
83,680. It's 38.4%. So 38.4, almost 40% of a person's income now is allocated to mortgage costs, whereas in the 1970s, it was less than 20.
And which is crazy too, because that's just the mortgage. That's not if something breaks in the house. You got to furnish the house. Insurance.
That's not taxes.
Yeah, it's not taxes in it, and then you got groceries, car, everything else.
Yeah. So this is a principal and interest payment versus a principal and interest payment in 1970.
Yep.
So why is all this important? On the Monday Market Talks, why are we talking about this? It's because it's not just the market, folks. It's how you behave in the market. It's what's happening around you. So when we look at these type things, it's where you have to come back to the big picture and look at your total plan, look at the total strategy. It's where we have to bring together actuarial science with investments and learn how all of that working together in a harmonious fashion is really what makes up your plan, whether it's an income distribution plan or whether it's an accumulation plan. What we can see today is how do young people deal with the plan of making enough money to make up that difference. So what that shows me, Isaiah, is that wages have got to catch up to prices.
Yep.
And until wages catch up to prices, we're going to be potentially facing some real issues in the U.S. that are going to be hard to overcome long term.
And that's where it comes down to. We got to find somebody or an economist or somebody that can help guide and steer that direction for the U.S. because it is hard. Because if you go to the grocery store and you got to pay, let's say, keep it simple, you got to pay a cashier and they need a raise. In turn, it ends up the cost gets passed down.
The eggs get more expensive because you had to pay the cashier more.
The cost gets passed down to the consumer.
So is this where AI maybe comes in the future,
Mm-hmm.
and AI helps lower some of that cost because now we have a smart register who I can just walk through a big scanner,
Yep.
and it knows exactly what I bought, and then that immediately finds what credit card I use in that store,
Mm-hmm.
and it zaps the credit card for my groceries, and maybe instead of having a cashier standing there waiting for me to come through, maybe that cashier's in the back helping unload or stock or do the things that robotics can't do yet.
Yeah.
So these are things that we contemplate all the time here.
Yeah, and it also goes, if you want to keep hitting on economics, it's also people are like, okay, maybe we raise taxes on people, big corporations or wealthy billionaires. We raise the tax on them. And what I always bring up to the point is when you raise tax on somebody that kind of not manipulates the rules, but has a big say in some things speculative to the market, when you raise something on them, the cost, like in my opinion, gets passed back down.
It's a trickle-down effect.
What's the second and third order effects of if you're gonna look at Tesla, for example, they're losing a tax break. So what's going to happen to Tesla prices? See Tesla prices go up a little bit, or people are not going to stop buying, or people are going to stop buying their cars because they're not going to get that.
And then what happens to prices?
They drop.
They go on sale.
Mm-hmm.
Yeah,
there's two flip sides to it.
Right. That's supply, demand.
Mm-hmm.
If there's more supply and little demand, you're trying to get the stuff off your shelves.
Yep. And I like this week's market commentary because it kind of does. It goes over a bit of what happens in the retail space with Lululemon and Macy's. Yeah. Lululemon and Dollar Tree had their earnings reports. It showed up poorly. They didn't perform like they said they were. Macy's and American Eagle had a great performance, had a great earnings report, and the stocks reflected either side. So Macy's and American Eagle did well. Lulu and Dollar Tree missed on earnings, so they're down a little bit. But
are people just tired of seeing each other in stretchy pants?
I guess so.
And now we want to go to sweats. I've heard sweats are making a comeback.
Yeah, sweatpants. I like sweatpants. I get right in them every time I get home.
Yep.
But
me too.
I'm blanking on his name. There's an economist that we were watching. Talks about supply side.
Art Laffer?
Art Laffer.
Yeah.
I think one day we should sit here and play a couple clips from it if we're allowed to and talk about economics and the effects of supply side economics and what happens.
You know, if you'd like to hear more stuff like that and kind of go deep on some of these conversations outside of Market Talk Mondays. Market Talk Mondays. I'm getting ahead of myself. I'm trying to get on vacation next week. I'm already in vacation mode. Stay tuned. Hit the like button.
Yep.
Hit that subscribe button. Let us know some feedback. Talk to us. Let us know what you think about the content we're putting out. We'd love to hear from you. And things that you'd like to know more about as it relates to the world of economics and the investment world from Isaiah and the team at Foundation Investment Advisors. Reach out to us. We'd love to hear from you. As always, if you're a client of Kenneth Porter Company, thank you. We appreciate you. We love you guys, and stay tuned for more.
Yep, sounds
good.
Take care. See you guys.